Every day, millions of products move across America. From industrial equipment and medical supplies to retail inventory and consumer goods. Behind this massive flow of commerce are trucking companies responsible for keeping the economy running. Yet transportation has never been an easy business. Fuel prices fluctuate. Economic cycles impact demand. Competition is relentless. And many operators struggle to earn attractive returns over time. But one company has consistently defied those odds. For decades, Old Dominion Freight Line has quietly built one of the most efficient freight networks in the United States. While competitors fought for volume, Old Dominion focused on something different. Service quality, operational excellence, and long-term discipline. The result? Industry-leading profitability, exceptional returns on capital, and one of the strongest track records in transportation. So how did a trucking company transform itself into a compounding machine? What makes its business so difficult to replicate? And can Old Dominion continue creating value for shareholders in the years ahead? In this analysis, we'll break down the business, competitive advantages, financial strength, risks, valuation, and the long-term investment thesis behind Old Dominion Freight Line. To understand Old Dominion, we first need to understand the industry it operates in. The company specializes in less-than-truckload, or LTL shipping. In this model, multiple customers share space on the same truck rather than paying for an entire trailer themselves. For example, a manufacturer may only need to ship a few pallets of products, while another business ships several more. Old Dominion combines these shipments into a single transportation network, helping customers move freight more efficiently. But moving freight is only part of the story. What Old Dominion really operates is a highly coordinated logistics network. The company manages hundreds of service centers, strategically located across the United States, where freight is collected, sorted, transferred, and delivered to its final destination. Every shipment must arrive at the right place, at the right time, and in the right condition. That requires sophisticated routing systems, technology infrastructure, trained personnel, and years of operational expertise. Today, Old Dominion serves thousands of customers across a wide range of industries. Its customer base includes manufacturers, retailers, distributors, healthcare providers, construction companies, and many other businesses that depend on reliable transportation. Importantly, no single customer represents a significant portion of revenue, helping reduce customer concentration risk. Unlike companies that depend heavily on international trade or complex global supply chains, Old Dominion is primarily focused on domestic freight transportation within the United States. This allows management to concentrate on improving service quality and network efficiency within a single market. At its core, Old Dominion provides a service that businesses rely on every day. Products cannot generate revenue sitting in a warehouse. They create value only when they reach customers. And helping make that happen, quickly and reliably, is the role Old Dominion plays in the American economy. One of the biggest misconceptions about freight transportation is that every shipment business operates the same way. In reality, the economics of the LTL industry are quite unique. Success is not determined simply by how many trucks a company owns. What matters is how efficiently freight moves through the entire network. Every day, thousands of shipments enter the system from different locations, travel across multiple routes, and eventually reach customers spread throughout the country. The challenge is coordinating all of these moving pieces while maintaining speed, accuracy, and profitability. This is where scale becomes increasingly important. As shipment volumes grow, a carrier gains more flexibility in how freight is routed across its network. More freight creates more route options. More route options improve asset utilization. And better utilization can lower operating costs over time. The result is a business where operational efficiency often matters more than simple market share. Companies that consistently optimize their networks can create meaningful advantages that compound over many years. This dynamic has led the industry to become increasingly concentrated among a handful of large players with established networks and significant operational expertise. For customers, the difference between carriers is not simply transportation. It's consistency. A delayed shipment can disrupt manufacturing schedules, create inventory shortages, or impact customer relationships. As a result, reliability often becomes just as important as price. And in an industry where trust must be earned shipment by shipment, companies with a long history of dependable execution can develop stronger customer loyalty and pricing power over time. These characteristics help explain why the best LTL operators often achieve significantly better financial results than the broader transportation industry. If many companies operate in the same industry, why has Old Dominion consistently outperformed so many of its peers? The answer lies in a philosophy that has guided the business for decades. Rather than pursuing growth at any cost, management has focused on building a culture centered around execution. Every decision is evaluated through a simple question. Will this improve the customer experience? This mindset influences everything from employee training and terminal operations to technology investments and network planning. Over time, these small improvements have accumulated into a meaningful competitive advantage. Another key factor is discipline. Transportation companies often face pressure to expand aggressively during strong economic periods. Old Dominion has historically taken a more measured approach, prioritizing long-term efficiency over short-term volume gains. This has helped the company avoid many of the operational challenges that can arise when growth outpaces infrastructure. Technology has also played an important role. Over the years, the company has invested heavily in systems that improve visibility, optimize freight flows, and support better decision-making across the network. While customers may never see these investments directly, they contribute to a smoother and more reliable service experience. Perhaps most importantly, Old Dominion has built a reputation that cannot be created overnight. In industries where businesses depend on timely deliveries, trust becomes a valuable asset. Customers that consistently receive dependable service are often reluctant to switch providers, even when competitors offer lower prices. This combination of operational discipline, continuous improvement, and customer trust has allowed Old Dominion to strengthen its position year after year. And while none of these advantages may seem revolutionary on their own, together they have created a business that has steadily widened the gap between itself and many of its competitors. Great companies often possess advantages that become more valuable as time passes. For Old Dominion, those advantages are not tied to a single product, patent, or breakthrough innovation. Instead, they are embedded throughout the business itself. The first advantage is customer dependence. For many businesses, freight transportation is a critical part of daily operations. When shipments fail to arrive as expected, the consequences can ripple across supply chains, production schedules, and customer commitments. Because of this, transportation decisions are often based on more than just price. Businesses tend to favor partners that can consistently meet their operational requirements. A second advantage comes from the company's long-term investments. Over decades, Old Dominion has continuously expanded and upgraded its physical infrastructure. These assets represent substantial capital commitments that would be difficult and time-consuming for new entrants to replicate on a national scale. The company also benefits from accumulated operational knowledge. Managing a complex transportation network requires thousands of decisions every day. Experience gained over many years helps improve planning, resource allocation, and execution in ways that are not easily visible from the outside. Another advantage is financial flexibility. Strong profitability and cash generation allow Old Dominion to continue investing through both strong and weak economic environments. While some competitors may be forced to reduce spending during downturns, Old Dominion can continue strengthening its business for the future. Finally, the company benefits from reputation. In service-oriented industries, reputation is often earned gradually but can influence customer decisions for years. A strong reputation can support customer retention, attract new business opportunities, and reinforce the company's position within the industry. Individually, these advantages may not seem overwhelming. But together, they create a business that is difficult to challenge and even more difficult to replace. And that is often the hallmark of a durable compounder. When evaluating a potential compounder, investors should look beyond revenue growth and focus on whether the business becomes stronger over time. In the case of Old Dominion, the financial record tells a story of steady improvement across multiple dimensions. One of the most impressive aspects is the company's ability to grow while maintaining operational discipline. Many businesses experience declining efficiency as they expand, adding complexity faster than they can manage it. Old Dominion has largely avoided that trap. Instead, the company has continued to scale while preserving the characteristics that made it successful in the first place. Another important indicator is earnings quality. The company's profits have generally been supported by real business performance rather than financial engineering, aggressive acquisitions, or excessive leverage. This creates a stronger foundation for long-term shareholder returns. Cash generation has also remained a defining strength. A business that consistently produces cash has greater flexibility to navigate uncertainty, pursue opportunities, and invest for the future without depending heavily on external financing. This flexibility becomes especially valuable during periods when economic conditions are less favorable. Old Dominion has also demonstrated a remarkable ability to allocate resources efficiently. Over time, investments in facilities, equipment, and technology have translated into higher levels of productivity and stronger financial outcomes. Not every company can turn capital spending into lasting value, but the historical results suggest that Old Dominion has done so effectively. The balance sheet further reinforces the quality of the business. A conservative financial position provides stability and reduces the risk that temporary industry challenges become long-term problems. This allows management to focus on operating the business rather than managing financial stress. Perhaps most importantly, the company's financial performance has remained resilient across different economic environments. Freight demand may fluctuate from year to year, but the underlying business has consistently demonstrated an ability to adapt and continue creating value. For long-term investors, that consistency is often just as important as growth itself. Because the strongest compounders are not necessarily the companies that grow the fastest in any single year. They are the companies that can continue creating value year after year, decade after decade. A great business can create value. But over long periods of time, management determines how much of that value ultimately reaches shareholders. Old Dominion's leadership has historically taken a patient and disciplined approach to capital allocation. Rather than chasing rapid expansion or pursuing headline-grabbing acquisitions, management has focused on making decisions that strengthen the business over many years. This approach can sometimes appear less exciting than aggressive growth strategies. However, history has shown that disciplined execution often produces superior outcomes. One notable characteristic is the company's willingness to invest ahead of demand. Management has frequently expanded capacity and infrastructure before it becomes fully necessary, positioning the business to accommodate future growth without sacrificing service quality. While these investments may temporarily reduce short-term returns, they can create significant long-term benefits when demand eventually catches up. The company has also demonstrated restraint when evaluating acquisition opportunities. Many transportation businesses have attempted to accelerate growth through large mergers and acquisitions, often with mixed results. Old Dominion has generally preferred to maintain control over its operations and culture, choosing internal development over transformational deals. Another important aspect of capital allocation is shareholder returns. As the business has matured and generated increasing amounts of cash, management has returned capital through share repurchases and dividends while continuing to invest in the business. This balanced approach reflects a focus on long-term value creation rather than short-term financial targets. Equally important is management's alignment with business fundamentals. The company has historically emphasized operational performance, customer relationships, and strategic investments rather than attempting to manage quarterly expectations. That mindset encourages decisions that may not immediately boost results but can strengthen the business over time. For investors, this type of leadership can be an important competitive advantage. Because while competitors may change strategies with each economic cycle, Old Dominion has largely remained committed to a consistent philosophy focused on building a stronger business year after year. And over decades, that consistency has become one of the company's defining strengths. Despite its impressive track record, no investment thesis is complete without examining the risks. Even exceptional businesses can face challenges that affect future returns. One of the most important risks for Old Dominion is the broader economic environment. Freight volumes are closely tied to business activity across the economy. When manufacturers produce less, retailers reduce inventory, or businesses slow spending, shipment demand can weaken. Although these periods may be temporary, they can still create pressure on growth and profitability. Another risk is the possibility of structural changes in customer behavior. Supply chains continue to evolve, influenced by technology, automation, and shifting distribution strategies. If freight flows change significantly over time, transportation companies must adapt their networks accordingly. Execution risk is also worth considering. Old Dominion's success has been built on decades of operational excellence. Maintaining that standard becomes increasingly challenging as the business grows larger and more complex. Even strong organizations must continuously adapt to changing market conditions, customer expectations, and workforce dynamics. Labor remains another area of uncertainty. The transportation industry depends on a large workforce, including drivers, dock workers, and operational personnel. Competition for skilled labor can increase costs and create staffing challenges, particularly during periods of economic strength. Technological disruption is another factor investors should monitor. While transportation remains a physical business, advances in logistics software, automation, and other emerging technologies could reshape parts of the industry over time. Companies that fail to adapt may find themselves at a disadvantage. Finally, there is the risk that expectations become too optimistic. When a company develops a reputation for quality and consistency, investors often become willing to pay increasingly higher prices for its shares. In those situations, future investment returns may depend not only on business performance but also on whether those expectations prove realistic. None of these risks necessarily undermine the long-term investment case. However, understanding them helps investors maintain a balanced perspective. Because successful investing is not about finding businesses with no risks. It is about understanding which risks matter most and whether the company is capable of managing them over time. A great business does not automatically make a great investment. The price investors pay matters. And for a company like Old Dominion, that distinction becomes especially important. Over many years, the market has rewarded the company with a premium valuation. Investors are willing to pay more because of its strong execution, consistent profitability, and long-term track record. But even the highest quality businesses have limits to how much future growth can justify. Based on our valuation framework, the conservative scenario suggests a value of approximately $127 per share. This assumes slower growth and more cautious market expectations. Using historical assumptions that better reflect the company's long-term performance, fair value rises to around $150 per share. This represents our base case estimate and serves as a reasonable benchmark for intrinsic value. Under a more optimistic scenario, where Old Dominion continues delivering exceptional operational performance and the market maintains a premium valuation multiple, the estimated value could reach approximately $264 per share. The key takeaway is not that one number is correct and the others are wrong. Valuation is ultimately a range, not a precise figure. What matters is understanding the relationship between price and future expectations. When a stock trades significantly above intrinsic value, investors are relying on strong future growth to justify today's price. When it trades below intrinsic value, the probability of attractive long-term returns generally improves. For Old Dominion, the business quality is not the primary question. The company has already demonstrated its ability to create value over many years. The more important question is whether the current market price provides enough margin of safety for future investors. Because even the best compounders can produce disappointing returns if purchased at overly optimistic valuations. And that is where valuation becomes just as important as business quality itself. Old Dominion has built one of the strongest franchises in the transportation industry. The challenge for investors today is not determining whether it's a great business. The challenge is determining whether the current price still offers an attractive opportunity to participate in its future compounding journey. Old Dominion Freight Line may not be the first company investors think about when searching for exceptional businesses. It doesn't sell consumer products. It doesn't dominate headlines. And it doesn't operate in a fast-growing technology sector. Yet over time, it has quietly built something far more valuable. A business that plays a critical role in the movement of goods throughout the United States. A business that has strengthened its position through decades of disciplined execution. And a business that has consistently converted operational excellence into shareholder value. What makes Old Dominion particularly interesting is that its success is not dependent on predicting the next trend or launching the next breakthrough product. Instead, it relies on doing thousands of small things exceptionally well, every single day. That may sound simple. But history has shown that consistency at scale is one of the hardest advantages to replicate. Looking ahead, the company will undoubtedly face challenges. Economic cycles will continue. Freight demand will fluctuate. Competition will remain intense. And future returns will depend not only on business performance, but also on the price investors are willing to pay for the stock. However, when evaluating businesses through a long-term lens, Old Dominion possesses many of the characteristics often associated with durable compounders. A critical service. Strong market positioning. Disciplined management. Financial strength. And a culture built around continuous improvement. For investors seeking the next exciting story, Old Dominion may appear unremarkable. But for those who appreciate businesses that steadily create value over decades, its story becomes much more compelling. Because sometimes the best investments are not the companies that attract the most attention. They're the companies that consistently execute while the rest of the market is looking somewhere else. And Old Dominion Freight Line may be one of the clearest examples of that principle in the transportation industry today. Closing line. The question is no longer whether Old Dominion is a great business. The real question is whether today's valuation still offers investors a chance to participate in the next decade of compounding. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching, and if you enjoyed this analysis, don't forget to like, subscribe, and share your thoughts in the comments below.